Okay, so in this video, I'm going to talk a little bit about some annuity basics. So basically for an annuity, we have kind of three pieces. Same amount every period for a specified number of periods. So that's typically the characteristics we have of an annuity. Same amount per period for a specified number of periods. Now, that's basically what's going to happen when you start receiving the payments. But in reality, for an annuity, there are actually a couple different phases that sort of occur for the annuity sort of process. The first phase that we have is basically an accumulation phase. So for the accumulation phase, this is when the person is actually paying into the annuity or kind of accumulating money, which will then be used to fund the annuity payments that come later. So this would be if somebody is contributing to an annuity, maybe in their 20s and 30s and 40s, and then they start receiving annuity payments after that. The annuitization phase is basically after the money has been accumulated. So after we've hit the end of the accumulation phase, then that lump amount of money, whatever's in there, is annuitized. And once it is annuitized, then basically it is turned into a series of payments that happen thereafter. And that's what's called the annuitization phase. Now, for the annuity company or the company that's for issuing the annuity, one of the issues that they might have is if they have, say, an annuity, let's say it's a lifetime annuity that lasts for the life of the person, then there is a risk because the company doesn't necessarily know how long any given individual is going to live. So if they're trying to figure out from that lump sum after the accumulation phase how much to offer in terms of regular payments, there's a little bit of a risk here in terms of, well, we don't know how long this person's going to live, and we have to make sure we don't offer too much because otherwise it's going to bankrupt the company. And so that's kind of a concern. So what the companies do is they basically they pool risks because they don't know how long any individual is going to live. But statistically, they can get a really good sense for how long people are going to live if you look at a whole group of people. And so they will essentially be pooling those risks across all these people that they're writing these contracts for. And what will happen is somebody who dies early may not receive as many annuity payments, and somebody who lives to 105 would get a whole lot more. But across the whole group, the insurance company would essentially wind up with the appropriate amount of payments relative to the money that had been annuitized. So really kind of one of the trade-offs that people have when they're looking at purchasing an annuity, really what it comes down to is on the positive side, you get sort of a guaranteed income. So kind of a guaranteed income situation versus the costs and fees that you're paying in order to produce that. So that's kind of the trade-off at some level. And I'll talk about some other aspects of trade-off in perhaps a subsequent video, but that's kind of one of the big picture trade-offs. Guaranteeing the income on the one hand, but there are fees and costs associated with doing that. And are those fees and costs worth it? And that's something that a personal financial planner could help to evaluate whether it really makes sense based on the annuity that's involved, what the fees and costs are, and what the objectives and other financial situation is for an individual. So let's talk a little bit about the parties to an annuity contract. So if we have an annuity contract, we have several different people who are party to the contract. So the first person is the annuitant. This is the person that the contract is linked to. And so this is the person who's maybe their lifespan or how long they live is sort of dictating things. That's kind of the idea. The beneficiary is going to receive the death benefit for the contract if there is a death benefit. The annuity contract doesn't necessarily have a death benefit, but it might. So if there is one, the beneficiary is the person that receives the death benefit. The owner is the person who owns the contract and who specifies the annuitant and the beneficiary. So the owner could be the annuitant, the person who is linked to the the contract. The owner could also be the beneficiary. The owner could be a company, perhaps. So there are a number of different people who could be the owner. But it's the owner is the person that actually owns the contract and specifies who the annuitant is and who the beneficiary is. And then, of course, there's the insurance company that is receiving the premiums and then ultimately making the payments later. Now, for annuity payout periods can be sort of in general either fixed or indefinite. So a fixed term would be a situation in which an annuity might pay out for a 10 or 20-year period. Let's say it's a 20-year period fixed term annuity. That would mean that it's going to pay out for that 20 years. If somebody bought a 20-year fixed term annuity when they retired at 65, then we're back to that issue of possibly running into superannuation where the person sort of outlives their money, where they could live to 86 and the annuity ends at 85. This is a 20-year annuity purchased when they're 65, and now the money is gone. They don't have any more money. So that's something to watch out for with a fixed term. Is the term appropriate given life expectancy, the other financial resources available, the goals that are kind of set for this type of annuity? Another type of annuity payout period would be indefinite. So this would be kind of like an annuity in which it's paid for the life of the annuitant. And so however long that person lives, they receive the payouts. And of course, we don't know exactly how long that will be, hence the indefinite term aspect of that. Now, there are a couple different ways that an annuity could be purchased, basically. The first one would be immediate payout. And this would be when somebody walks up with a lump sum, they hand over a lump sum to the annuity company. In exchange, they start receiving payments immediately. So this would be maybe somebody retires, they have a whole bunch of money in their account, and they basically annuitize some of it, and they start receiving fixed payments thereafter. That's kind of the idea behind the immediate payout. Little side note, for reasons that will be discussed in subsequent videos, probably a bad idea to annuitize all of your retirement savings because it gives you very little flexibility later, and there's some other downsides that we'll talk about later. Another approach would be the deferred payout approach. So this would be one in which payments start later. So in this case, this would be where somebody, for instance, might be setting aside money, let's say, and purchasing an annuity over years. And so if they're purchasing an annuity over years, they aren't receiving the payouts immediately. They're going to be setting that aside during that accumulation phase. And then they're going to hit the annuitization point, and then the payments occur. So in that case, that's a deferred payout situation. And that kind of brings us to how premiums could be structured. So in that immediate payout scenario, that would be an example of a single premium annuity. So a single premium annuity would be one in which the person who buys the annuity just pays once, and then the annuity is entirely paid up. They don't have to pay again. A flexible premium annuity would be one in which the person is paying over time. So this is like the deferred payout kind of scenario. So they're paying over time, the payout happens later. And in that case, it's flexible because depending on how much money is set aside will ultimately dictate what winds up being accumulated, which then will wind up dictating what the payout will wind up being later. So with the flexible premium, the premiums are flexible, but because they're flexible, you don't know exactly what the payout level is going to be when it is annuitized because it depends on what's been accumulated, basically. Now, during the time that the money is or the annuity is in the accumulation phase, then basically what's happening is the earnings potentially, because there are the annuity is generating earnings, the earnings and the premium. So what the person is paying and the earnings on whatever has been contributed are going to drive the account value, and so that's what's going to drive sort of that accumulation, which is then ultimately at some point annuitized. And that brings us to the idea of fixed versus variable annuities. And this will be addressed more in a subsequent video, but here's the basic idea. For a fixed annuity, pretty much what's coming from that is the person is buying the annuity, and in exchange, they're going to get certain fixed payments. So a particular fixed payment level. Variable annuity is one in which the amount that the person receives in terms of payments is actually going to vary based on something. Typically investments. So the person may be during the accumulation phase investing in stocks, for instance, through the annuity. And so what winds up being the payout depends a lot on how those investments, like say stocks, perform during that accumulation period. And that's a variable annuity because you don't know what that's going to turn into and what that could actually produce. Okay. Hopefully these little basic kind of starter points for annuities have been helpful. And hope you have a great day. And thanks for watching.